Hello and welcome to session 21 of the Basic Tax course. We're going to begin session 21 with a review of the session 19 quiz answer key. I have the session 19 quiz up on the screen in front of you, and the first most frequently missed question from the session 19 quiz was question number 1. Rental income qualifies a taxpayer for the Earned Income Credit or for an IRA contribution if the taxpayer materially participates in the rental activity. Well, that's a definite false, and I've gotten even a little bit sarcastic with my notations here. What? Let's go back to the beginning here, where from very early on in this course with wage investment and other income, that session early on, and also in our session on IRA deductions, we talked about the need for earned income. Now, in the case of an IRA deduction, you can have earned income or alimony, which is considered a form of compensation. But other than in the IRA deduction, certainly when you're talking about the earned income credit, the definition of earned income credit is earned income. And rental income, by definition, is always passive and never earned. When you look at the material participation rules for rental property, the material participation rules regulate or determine when an individual is allowed to claim a loss against other non-passive income from the operation of a rental property. But the material participation rule does not somehow construe that passive income can be considered to be wage income or self-employment income. So to claim the earned income credit, you must have earned income. To claim an IRA deduction, you must have earned income or alimony as a form of compensation. And rental income will never qualify you for either the earned income credit or for an IRA deduction. Moving on, question number 2. You lived in a mobile home in the town of Cannon Beach, but you rented it out for 9 days in August while visiting your grandchildren in the city of Bend. You must declare the rent as income, but can take expenses up to that amount. That's a false. Remember the 14-day rule? If you rent your property for 14 or fewer days during the year, you don't have to report the income and you don't claim the expenses. It's one of the few situations in tax law where you can actually make money, keep it, and not have to include it on your tax return. Question number 7. Mr. Wilson rented an apartment in the basement of his home for the entire year. The apartment is 1,000 square feet in size, 25% of the total space in the residence. The total expenses for the entire building were as follows. We have mortgage interest of $2,500, property taxes of $900, utilities that were all paid by Mr. Wilson in the amount of $1,200, repairs that were made specifically and directly to the apartment in the amount of $150, insurance that covers both tax years 2011 and 2012 that cost $1,200, and then there was the fair market value of Mr. Wilson's labor to do some repairs around the house. That was worth $200. And then we have this comment for depreciable basis of the building. The building, excluding land, cost $40,000 and was assessed at $48,000 when Mr. Wilson started renting. Mr. Wilson is using 40-year straight line ADS to depreciate the apartment. So let's think a little bit about what's going on here in terms of computing our deductions. The question reads, what is the amount of rental expense that Mr. Wilson can claim on his Schedule E? So we've been given all of these expenses, and your job is to determine how much of these expenses are going to be deductible and then add them up and come up with a total. So the first thing we look at is that for each expense, we need to establish how much or what percentage of that expense is deductible. And we're telling you that we have a house and apartment, and the apartment is 1,000 square feet in size, making it 25% of the size of the building. And therefore, we're going to allocate 25% of the expenses that must be divided between personal and rental use. So if the apartment building is 75% business use and the mortgage interest paid on that building is $2,500, then it means only 25% of the $2,500 would be deductible on Schedule E, and that 25% equals $625. For the property taxes, the total taxes cost $900, and 25% of $900 is $225. The utilities were all paid by Mr. Wilson. They totaled $1,200, and 25% of $1,200 is $300. And then there were repairs that were made directly to the apartment. And since they were made directly to the apartment, but they're allowed in full, so we basically say $150 or 100% of the repairs made are going to go on the apartment. And then we have insurance, and we cannot claim prepaid insurance for 2012 as a current 2011 deduction. So we essentially take half of $1,200 and start from that point. And so half of $1,200 is $600. And of the $600, 25% is for the apartment and 75% is for Mr. Wilson's home. And that leaves us with $150 of the $600 being allowed as a rental expense for the current 2011 year. And then the fair market value of Mr. Wilson's labor, sorry, not an allowable deduction. So essentially, under the 25% column, I have entered the amounts that are deductible, and in the case of the $150 deduction for the repairs, technically 100% of that amount is deductible. So we go $625 plus $225 plus $300 plus $150 plus $150. But we're not done. We need to go down and look at the depreciation computation, and if we have a $40,000 property being depreciated straight line, we're going to take $40,000 times 25%, and that gives us $10,000 as a depreciable basis for the business use portion or the rental use portion of the apartment. And we'll take $10,000, divide that by 40 years, and we get $250 per year. So we add $250 to all of the other amounts, and those were $625, $225, $300, $150, $150, and finally the additional $250 for depreciation. You add those numbers up, you get $1,700, and that makes B the correct answer. The next question we're going to look at is question number 27. A taxpayer meets the material participation rules in which of the following situations? A, the individual participated in the activity for at least 450 hours. Sorry, the amount's actually 500 hours, so 450 isn't enough. B, the individual participated in the activity at least as much as any other owner of the activity, but less than the employees of the activity. Sorry, no, it has to be at least as much as any other participant in the activity, including employees in the activity. So B is out. C, the activity is a personal service activity, and the individual participated in the activity for any 3 prior years which do not need to be consecutive. That is the correct answer. And finally, D, the individual materially participated in the activity for 3 years in any 10 of the immediately preceding years. That is an incorrect statement. That rule is applicable only to personal service activities, and it doesn't state that it's a personal service activity. If it is not a personal service activity, that rule does not apply. Question number 28. A taxpayer may claim prior year suspended losses upon the disposition of a passive activity in a sale to a related party. That is false because it says related. If it was a sale to an unrelated party, then the losses are allowed, but in a sale to a related party, they remain suspended. Mini problem. Jessie Mitchell rented out a basement apartment in her home for the entire year. The apartment takes up 50% of the square footage of Jessie's home, and during the year she had the following income and expenses for her rental unit. And here we have Jessie's Schedule E over on the right-hand side of the page, and let's just take it line by line. We'll see that the monthly rent received was $12,000. What's relevant about the rent is down in this last paragraph here. We say, in June, Jessie allowed her tenant to paint the house in exchange for 1 month's free rent. And yet up in the problem, we're telling you that $12,000 was collected. And when it comes to reporting income from the rental property, if you exchange services for free rent, the value of the rent that is traded for those services is considered to be rent income. And therefore, even though there is 1 month out of 12 where no rent was technically collected in the form of a cash payment, we're still going to say that $12,000 was collected for the year. The next item is utilities. And we're telling you here in the wording of the problem that the utilities of $1,000 were for the apartment only. So all $1,000 will carry down and be entered on line 17. Next, we have advertising. The advertising is 100% allocable to the rental property, and therefore we enter all $50 on line 7. Insurance for the entire house. Well, the entire house is $300, but we're only renting half of it, so we get half of $300 or $150 to enter as an expense on line 9 of the form. Next, we have depreciation. Depreciation is, of course, claimed only on the rental property. We've told you that it is $1,200, and it will be entered on line 18. Next, we have mortgage interest for the entire house. Well, the house is 50% rental, so we'll take 50% of $7,000 and enter that on line 12. That's $3,500. And then finally, the property taxes, 50% of $1,800 is entered on line 16, and that is $900. Next, we look back at, again, this final paragraph. In June, Jessie allowed her tenant to paint the house in exchange for 1 month's free rent, and then Jessie also paid $400 for the paint that was used to paint the house. Well, the value of the labor and the paint is going to be a deductible expense to the extent it applies to the rental portion of the apartment. So what we look at here is that if it costs essentially $1,400 to paint the apartment and the house combined, and that the house apartment is 50% rental, then it means 50% of $1,400 or $700 is an allowable expense, and we will enter $700 on line 7 as a repair and maintenance expense. So in completing Jessie's Schedule E, we can see we've entered all of the allowable expenses. The expenses total up on line 20 and are $7,500. That gives us a $4,500 profit for the year, and that is the final Schedule E for Jessie Mitchell. So that concludes the review of the Session 19 quiz assignment. There is no homework assignment to review for Session 20 since the Session 21 lecture has yet to be completed. We're going to be giving you a homework assignment at the end of today's class, but we did not give you an assignment at the end of Session 20. So with that, it is now time to begin the Session 21 lecture. Please pick up where you left off. And today's topic will begin with office use of home on Form 8829. Because that would make it temporary versus long-term. Got your log filled out? See, when you attend a webinar, you don't have mileage expense getting to me. My students here in the classroom all had to use gas getting here. Form 8829, we're up to that point now. Form 8829 is the form that you use to deduct business use of home. And you are allowed to use business use of home expenses provided you meet some pretty important tests. Firstly, the home must be your principal place of business for any of your trades or businesses, or it must be a place of business used by your patients, clients, or customers to meet or deal with you in the normal course of your trade or business, or in connection with your trade or business if it is a separate structure that is not attached to your home. There are two exceptions to this principal place of business and exclusive business, and those are if you use your home for inventory storage or if you operate a daycare from your home. In those two situations, you don't have to use regular and exclusive. It would just be regular. Inventory storage, you use this space, that is, you have inventory storage if you are using the space on a regular basis to store inventory or product samples, and your home is the only fixed location of your trade or business. Principal place of business. Your home will qualify as your principal place of business for deducting expenses for its use if you meet the following requirements. Number one, you use it exclusively and regularly for administrative or management activities of your trade or business. Examples include billing customers, clients, or patients, keeping books and records, ordering supplies, setting up appointments, and forwarding orders or writing reports. And you also have no other fixed location where you can conduct substantial administrative or management activities of your trade or business. Here is the form itself. And just as in Schedule C, I'm going to break it down and take it line by line. We'll look at Part 1, and then we'll look at Part 2, and then I have a couple of illustrations with it all filled out, including this depreciation section on home and the carryover section and how those work. So we begin in Part 1. You use this section of the form to determine the percentage of your home that qualifies as business use. There are two parts to it. The first one is establishing what portion of the home is used for business. How many square feet is the house? How many square feet is the room? And you arrive at percentage. Then if the home is used for daycare, you also do a proration where you look to see how much of the time children are in the home. So how many hours a day children are in the home. And we have an example here. Mary Contrary uses her basement to operate a daycare business for children. She figures the business percentage of the basement as follows. She has the square footage of the basement and the square footage of the whole house. 1,600 square feet of the house is used for the daycare business. The whole house is 3,200 square feet. So it's 50% of the house is used for daycare. She used the basement for daycare an average of 12 hours a day, 5 days a week for 50 weeks in the year. During the other 12 hours of the day, the family could use the basement. She figures the percentage of time used for daycare as follows. The number of hours used for daycare is 12 times 5 times 50, or 3,000 hours in a year. And the number of hours that the home is available or could be available for business use is 8,760 hours. So she gets 3,000 divided by 8,760 for 34.25% business use. Mary is allowed to deduct 34.25% of any direct expenses for the basement. However, because her indirect expenses are for the entire house, she can only deduct 17.3% of the indirect expenses. And here is the filled out 8829 for Mary. So we show 1,600 square feet of business use, 3,200 square feet is the entire house, 50% is the portion of the house used for business. We have the number of hours used for business, the number of hours in a year to get the decimal amount. And essentially we take business percentage, we multiply line 6 by line 3 and enter the amount on line 7. All others would just carry line 3 down to line 7. So if you're not a daycare business, you'd carry line 3 to line 7. So how do you figure your allowable deduction? Direct expenses are amounts that are 100% attributable to your home office, and indirect expenses are expenses attributable to all areas of your home. Most people will be entering expenses into the indirect column. It would be not terribly common to have a direct expense, but it is possible. I suppose you could have a repair that you do directly to a room, or you paint a room directly, but most of the time costs are indirect. A direct expense is the cost of repairing the doorknob on the door of your home office. An indirect expense would be the cost of electricity used to heat your entire home, including your home office. Now, 8829 itself, if we go back up to this earlier page here, if you observe, we've got line 9, 10, and 11. Casualty losses, deductible mortgage, real estate taxes. And then we do some calculations, and then we start listing more expenses like insurance and rent. Why are those separated out? They are separated out for a very good reason. We're going to talk about that. So the areas that are separated out and listed at the top include casualty losses, deductible mortgage interest, and real estate taxes. All of these expenses are amounts that are allowed on Schedule A. So they're also allowed on 8829 and Schedule A at the same time. Those expenses, 9, 10, and 11. So those are all expenses you could claim on Schedule A. But we go down to the next part of the form, lines 16, 17, 18, 19, 20, and 21. Those are amounts that would not be deductible on Schedule A. They're separated out. And the relevance of that happens in how the deduction for home office is allowed or not allowed on Schedule C. The bottom line is that on Schedule C, you cannot use expenses that appear in the bottom half of the Form 8829 to create a loss on Schedule C or increase a loss on Schedule C. If you have home office expenses for the first 3 categories, and it's namely going to be home mortgage interest and real estate taxes, even if your business is running at a loss, those expenses are still allowed and you can still claim them on Schedule C. So in effect, the only time these other categories of expense will benefit a small business is when that small business is profitable. And then it can use these expenses to offset. So we have excess mortgage interest. If you have excess mortgage interest that's not deductible on Schedule A, you would enter that on line 16. Line 17 is where you enter liability and hazard assurance and mortgage insurance that you pay on your home. If you don't own your home and you in fact rent it instead, you would enter that on the rent line. Line 19 is where you enter repairs and maintenance. Line 20, you enter all of the different utilities you pay for the house. But one of the utilities that I never put there is phone, because basically your main home phone line is not deductible as a business expense. IRS reasons you'd have it anyway. And if you're claiming cell phone, you don't want to be prorating that by home office expense. It's not got anything to do with your home office expense, so don't put cell phone there either. And then when we get into internet, I think internet use is something that's tracked completely separately from office use of home. How big your home is has nothing to do with how much internet use is for business. So there are certain types of expenses we might think of as utilities, but I never put them on the utility line. Do separate calculations for those. And then line 21 is for any other expenses that you couldn't fit on one of the earlier your lines, provided the expense seems reasonable and is related. The next section, yes. Well, there's a question in the classroom. You have cable so that your daycare business can play cartoons for the children because they like to watch that. Is that something you'd put on utilities? I wouldn't put that on utilities either. I would claim that as a direct expense, and I'd prorate it by the cost that's allocable to the children. For example, if you subscribe to the Disney Channel for their benefit and you wouldn't have the Disney Channel otherwise, I would directly claim that as an expense for the children on Schedule C. And if you've got, an overall cable subscription that you paid for an upgraded subscription to provide extra channels for the children, I would claim that difference in the upgrade directly on Schedule C and not on 8829. Now, if you own the home that you are using for your business, you will need to claim depreciation on your home, and you figure that depreciation in Part 3. But if this is the first year you're claiming depreciation on your home office, you also have to attach Form 4562. And then in Part 4, you enter a carryover of an unallowed loss from 2012. If you had expenses that are not allowed because you ran a loss on your business, those unallowed expenses carry forward to the next year. And you figure the amount of unallowed expense and enter it on line 42 and 43.
Password number 1 is Middle Earth, MIDDLEEARTH.
So I wanted to do an illustration for you of how 8829 is filled out when you have a profit and when you don't have a profit, how it changes. So here in this illustration, I would like you to assume the following. Firstly, we have a business with a profit. It's not a big profit, just $5,000, but it is a profit. The home office expenses are as follows. Mortgage interest $10,000, real estate tax $1,000, insurance $500, repairs and maintenance $2,000, utilities $1,000. The home office is 2,000, or the home is 2,000 square feet. The office is 200 square feet. There is a carryover of home office expenses from 2010 in the amount of $300. The basis of the home is $150,000, of which $50,000 is land value. So the starting point is to enter the square footage of the home and the square footage of the office. We end up with 10% business use. Simple enough equation. Then we move over to page 2 and start entering more numbers. We start on line 8 by entering the profit from the business, which is $5,000. Then in the indirect expense column, we enter the amount of deduction for mortgage interest and real estate taxes. We add those two amounts together and we get $11,000. And then we multiply those by the business use percentage of 10%, we get $1,100. We carry the $1,100 over to line 14, subtract that from line 8, and we get $3,900. The next step is to figure all of the other expenses that we had for the year that are not normally deductible on Schedule A. And we had insurance, repairs and maintenance, and utilities. All right, so we've got $2,000 here, $1,000 here, and we add all of those deductions up and we get $3,500. We have $3,500 of expense associated with the house that would not be deductible on Schedule A under any circumstances. And then we multiply those expenses by 10% business use and we get $350. The next line is where we enter the carryover of operating expenses from the earlier year, and that's $300. Then we say, do we still have a profit? Because that's the next test. And the answer is yes, we still have a profit. So we take 350, 300, add those together, and we get 650. And 650 is less than the number on line 15. So we deduct 650 from line 15 and enter the difference on line 27. That is the net profit after deducting home office expenses, but before depreciation. The next step is to figure the depreciation, and that's done down here under depreciation of home. And there we start with the acquisition cost of the house. We subtract out the land value. We get the depreciable basis of $100,000. And then the formula says to multiply that by 2.564%. And 2.564% is basically 1 divided by 39. So the depreciable life of a home office, this is commercial use, therefore it's 39-year property, is not 27.5-year property, which I often see preparers think they should do. So 39-year property is the depreciable life of a home office. And that gives you $256 of depreciation.
$256 of depreciation is still less than the profit after deducting other home office expenses, so we're going to get to claim it too. And ultimately, we take the $650, the $1,100 up here, and the $256 and add those together, and we get $2,006 is an allowed expense. So we're going to enter all $2,006 on line 30 of Schedule C, subtract that from the business profit of $5,000, and on line 31 we enter $2,994 as the net income after home office expense. Let's see how that formula changes when the business is a loss. So in this business, everything is the same except we now have a loss of $5,000. So we have the same $10,000 of mortgage interest, we have the same $1,000 of real estate tax, we have the same 10% business use. So line 13 is the same $1,100. But this time when we come over here, we have 5,000 minus 1,100. We can't do that. Line 15 can never be less than 0. So line 15 is 0. We go over and we add up all of the other expenses the way we did before. We total them and we get 3,500. We multiply them by 10%, we get 350. We add in the carryover from the year before and we get 650. And we go down and figure our depreciation. We still get 256 and we enter it. But essentially the math says these numbers don't get deducted. The 650 and the 256 are non-deductible amounts, and so they get entered in the carry forward column down here on line 42 and line 43. But the $1,100 amount is allowed. So we carry the $1,100 over to the Schedule C, and the $1,100 does allow us to increase the loss from $5,000 to $6,100. There's a question when I'm figuring my square footage, do I figure common areas? Well, the answer is yes. You have the square footage of the home, and it includes common areas. And the only part of the home that you are allowed to claim business use of is the exclusive area that is not used for anything, and it's certainly not common, except business. And then if you have a home daycare, you're allowed to claim business use of home even if it's not exclusive, and then you have that extra percentage where you figure the number of hours of use. So the next topic of the day is the domestic production activities deduction. We'll squeeze it in and then we'll take a break. The domestic production activities deduction is a deduction you are allowed to claim if you have income from a business. For 2011, you may be able to claim a deduction of up to 9% of your qualified production activities from income in the following areas. Construction of real property performed inside of the United States. So if you are building homes, building decks, building bridges, those are things that are construction inside of the United States. Or engineering or architectural services performed inside the United States. Any lease, rental, sale, exchange, or other disposition of tangible personal property, computer software, and sound recordings that the taxpayer manufactured, produced, grew, or extracted in whole or in significant part within the United States. Any qualified film produced by the taxpayer, and any electricity, natural gas, or potable water produced by the taxpayer. In certain cases, the United States does include Puerto Rico. Your deduction may be reduced if you had oil-related qualified production activities. The deduction does not apply to income from the sale of food and beverages prepared at a retail establishment such as a bar or restaurant, or to property leased, licensed, or rented for use by a related person, or to the transmission or distribution of electricity, natural gas, or potable water, or to the lease, rental, license, sale, exchange, or other disposition of land. Who qualifies for the deduction? To qualify to claim the deduction, you must have net income or a profit from qualified production activities. So that means that if you're filing Schedule C, you get to the bottom line after all of your deductions, and you have a profit. That's the first step. The second step is that you have to have employees. So you have to have paid wages out during the year. You have to actually be issuing W-2s to employees. That's the second step. And the third one is you have to actually be manufacturing an item. Now, you may also qualify for the domestic production activities deduction if you are a self-employed person who is working, well, actually not self-employed, but if you have a K-1 from an S corporation or a partnership. If the partnership or the S corporation qualifies for the deduction, it will issue you a K-1 showing the amount that you can claim, and you need to fill it out on your form. So how do you calculate the amount of the deduction? Well, the deduction is the lesser of 9% of the qualified production activities income, or 9% of the taxable income, but never more than 50% of your W-2 wages. How to claim the domestic activities production deduction? Well, you fill out Form 8903, figure the deduction, and enter it on Form 1040, line 35. I did want to point out that if you are claiming the domestic production activities deduction, it is not at all unlikely that your state does not allow that deduction. The reason I say that is the state of Oregon does not allow the deduction, nor does the state of California. So in both Oregon and California, when you claim this deduction, you have an addition on the state return. So if Oregon and California are adding it back in, I would hazard to guess that a lot of other states are probably doing the same thing. If your states are working off of same income and deduction rules that the federal return is, you may get to this particular deduction and have them throw it out on you. Now, if you're dealing with oil-related production activities, the deduction is reduced by 3%. So the most it can be is 6%. You must be working in a trade or business. The qualified production activity and Form W-2 wages are figured only by taking into account items that are attributable to the actual conduct of a trade or business. An activity qualifies as a trade or business if the primary purpose for engaging in the activity is income or profit, and you are involved in the activity with continuity and regularity. For example, sporadic activity or a hobby does not qualify as a trade or business. Coordination with other deductions. Your deduction might be limited by basis limits on a partner's share of a partnership's losses, basis limits on a shareholder's share of S corporation losses, at-risk rules, passive activity rules, or any other provision of the Internal Revenue Code. You should refer to the instructions for Form 8903 for additional information about the deduction. Who qualifies? Again, in a nutshell, you must show a profit from a qualified domestic production activity. In addition to that, you, on the front of your tax return, have to have taxable AGI. So if your adjustments to income are so big it turns you into a negative number or a net operating loss, you're not going to be able to claim the deduction. And then in addition, you have to have actually paid wages out to employees. So how do you figure the deduction? Well, you figure it on Form 8903, and I have an illustration here. Jacob Marley owns a furniture business with the following income and expenses for the year. He has gross receipts of $100,000, and he has only two expenses, cost of materials and wages. Wages are for $25,000, cost of materials are $30,000. He has a net profit of $45,000. His allowable deduction will be the lesser of 9% of his net profit from the activity, or 50% of the W-2 wages that he paid. So we start off by looking on the form at his gross income. We deduct out his allowable expenses to arrive at his net profit from the activity. The next step, moving down the page, is to figure 9% of that amount, and 9% of $45,000 is $4,050. On this line, it's also asking for his adjusted gross income because he has to have positive AGI, so we threw that number in. Then we enter the amount of wage income he had, and we multiply the wages by 50%. We get $12,500. The deduction is the lesser of these two numbers. And of course, the lesser number is $4,050. That's the amount of the deduction. And it carries down to the front page of Form 1040 and gets entered on line 35. All right, so that concludes the domestic production activities deduction. We're on to business credits. And I'm not going to talk about any of them other than just to mention them by name, because we have a whole class next Thursday where we work on business credits and how to calculate them. But when you do run a business and file for self-employment, any of these credits is a potential that could come up for you. And if you qualify for any of these credits, typically you file Form 3800, and then you also file the form for the specific credits. So 3800 is the form you use for claiming the general business credit, and then in addition to that, you also claim all of the other credits associated with it. We have the investment credit, the America Samoa Economic Development Credit, the Work Opportunity Credit, the New Hire Retention Credit, the credit for alcohol used as a fuel, the credit for increasing research activities, the low-income housing credit, recapture of low-income housing credit, the orphan drug credit, the disabled access credit, qualified electric vehicle credit, renewable energy production credit, empowerment zone employment credit, the Indian employment credit, the credit for employer Social Security and Medicare taxes paid on certain employee tips, biodiesel, renewable diesel fuels credit, the new markets credit, the credit for employer pension plan startup costs, the credit for employer provided child care facility services, the low sulfur diesel fuel production credit, the qualified railroad track maintenance credit, distilled spirits, non-conventional source fuel, energy-efficient home, and then we move on to alternative motor vehicle credits, alternative fuel vehicle refueling property, mine rescue team, agricultural chemicals, carbon dioxide sequestration, qualified plug-in electric drive motor vehicle credit, and the credit for small employer health plan insurance. We are not going to cover every one of those credits, but I will cover the high points in our next class on Thursday next week. In particular, we look at the employer tips credit, the work opportunity credit, the small employer, or the new healthcare credit. Those are the ones that we really focus on. Now, your general business credit for the year consists of your carry forward from prior years plus the total of the current year credits. And if you are a qualified small business, the AMT will not take your credit away from you. A lot of these business credits, you go through all the work of calculating, and then the AMT takes them away. But for 2010, a law was passed that allows these credits to go to small businesses and prevents the AMT from taking them away. We're moving on now to reporting requirements for employers. I mentioned we would be covering this. If you have an employee, you have to file payroll reports and do certain things. An employee is a person who performs services under the direction and control of an employer. You need to remember, as an employer and as a tax preparer staring at an employer, this simple rule of thumb. If you are able to direct a person by controlling where, when, and how to work, then you probably have an employee. And this is a discussion I have two ways. I have clients who come in and they tell me that they've received a 1099 from their boss. And I'm saying, well, if you're working for that employer under his direction and control, he should have given you a W-2. So I'm looking at it from the employee's perspective. But on the other side of things, I do business tax returns and accounting for small businesses. And just as often, the conversation is the other way. You can't be 1099ing these people. They were your employees. And so I'm giving them advice on two sides. And so as a tax preparer, whether or not you do payroll, you should know when you're looking at a situation where payroll should be issued rather than a 1099. So remember the rule of thumb. If you're able to direct a person by controlling where, when, and how they work, then you probably have an employee. The IRS says it does not matter if your employee works from home or uses his or her own tools. What matters is whether you control the method and manner in which your employee provides services to you. If you have an employee, you need to pay them wages on a W-2, and in addition to that, you need to file the payroll forms. There are forms 941 and 940 to begin with. There are usually others as well. And the way it works when you pay an employee is you withhold 6.2% Social Security tax, but for 2011 the tax is 4.2%, and for 2012 it is also 4.2%. And then you also withhold Social Security tax at a rate of 1.45%. You are also required to file Form 941 every 3 months to report your Social Security, Medicare, and federal taxes that were withheld from your employee's pay. When filing Form 941 as an employer, you must pay matching contributions of 6.2% Social Security and 1.45% Medicare tax. Now, gone are the days where employers would mail in these taxes with the 941 forms. The IRS does not want you mailing money with these forms ever. And gone are the days when you went down to the bank and paid the taxes through the bank. These days, the only way IRS wants its money is through their electronic filing payment system, EFTPS. So EFTPS is easy to set up, easy to administer, easy to make payments through. We do it for many clients. Clients can do it for themselves, but that is the system that these taxes should be paid through. If you are an employer, you must also pay federal unemployment tax by filing Form 940 FUTA, federal unemployment tax, on an annual basis. And as I said earlier in the class, that's due January 31 each year. The IRS has a Social Security Number Verification Service, or SSNVS, that employers can use and should use to verify that the employees they are hiring have given them valid Social Security numbers. The system allows an employer to easily detect when they've been given an invalid Social Security number, such as by an illegal worker, or a person who's just basically giving them a fake number because they don't want IRS to start garnishing their wages, for example. So that system is also easy to use. You can verify up to 10 names and Social Security numbers per screen online and receive immediate results. The option is ideal for new hires. If you're a big business, you can overnight files of up to 250,000 names and have them checked. So by using this third-party, or by using this particular system, you can eliminate the problem of IRS notifying you when you file W-2s that the numbers and the Social Security numbers and the names on those W-2s are a mismatch or invalid. There is a lot of importance to be placed on correct Social Security numbers. It is recommended for the following reasons. That is, it's recommended you verify Social Security numbers for the following reasons. You want to make sure the names and numbers on the W-2s are correct. It is faster and easier to use than submitting requesting paper listings over the telephone with Social Security. It results in more accurate wage reports. It saves processing costs and reduces the number of W-2 corrections you have to issue, and allows the Social Security Office to properly credit your employees' earnings records. Now, of course, whenever we're dealing with illegal aliens in the United States, the problem is kind of sort of disappearing slowly over time. My own husband had his Social Security number used, presumably by an illegal alien, back in the 80s. He was in the military and out at sea, and shortly after we were married, he got a letter from the IRS, CP2000 type letter, saying he hadn't reported wages that he'd earned. And my husband was quite insistent that he had not held a job in California simultaneously whilst at sea in the Persian Gulf. He just couldn't manage those 2 feet simultaneously. But it was a lot of correspondence back and forth, and it took several months or a year to resolve. It was just a headache for us. And it's a headache for probably tens of thousands, hundreds of thousands of Americans around the country over time. And so the IRS is hoping that employers will use the system to eliminate that when people are not legal and are not permitted to be working in the country, that they will, in fact, not be able to with that system. So slowly over time, it is working. Now, which of the forms are you supposed to file if you are in business as a self-employed person? Well, there's a number of forms you're supposed to be filing, and we've spent a lot of time talking about Schedule C. If you're filing Schedule C and you have a profit, you also need to attach Schedule SE. You'll need to attach or mail in 1040-ES with your estimates. If you are an employer, you also need to file Forms 941 or 944, and the due dates for those reports are shown here. You should refer to Publication 15, which is the employer handbook. Providing information to Social Security and the W-2s, you need to issue W-2 to your employees by the 31st of January. You need to submit your W-2s to the Social Security Administration by the last day of February, but you get an extra month if you're doing it electronically. The FUTA Report 940 is due by January 31st. It is also, payments are due throughout the year if you owe more than $500 at the time you file. And then the 1099 filings, those 1099 miscellaneouses, those are due to the recipient by January 31st each year. They're due to the IRS by February 28th, and you get a month extra time if you're e-filing them. The next tax we're going to talk about, or the next item in line to talk about, is self-employment tax. Self-employment tax is not a horribly complex calculation for most people. There's 2 sides to the Schedule SE, the front and the back. They both accomplish the same results. You only do one side or the other and not both. And the first thing you do is look at the flow chart or the worksheet on front of side 1. And if the worksheet tells you you're allowed to use side 1, you use side 1. And if the worksheet tells you you can't use side 1, then you use side 2. Now, how do you go about calculating the self-employment tax? Well, essentially, in the back of your head as a tax preparer, you already know the calculation. You take the net income from the business on Schedule C, you carry that over to the Schedule SE, and you multiply it by this figure, which is 92.35%. And then after you've got the 92.35%, you multiply that by 12.4%, and you're there. So the mental math is there, and the form has you walk through the steps that get you there. Now, normally the self-employment tax rate is 15.3%, but for 2011 and 2012, it's been dropped down by 2 percentage points. So normally we're looking at 10.4% and 2.9% going to Medicare for 2011 and 12 instead of the higher amount. And so the total amount for 2011 is 13.3 rather than 12.4. The social, it's actually should be 13.4, shouldn't it? The Social Security component of self-employment tax is limited to the first $106,800 of wages. So the reason the self-employment form is a little bit more complicated than just profit multiplied by 92.35 multiplied by 13.4 is because we have to deal with the Social Security limit. And if your income goes above $106,800, you no longer need to pay the self-employment portion that is Social Security tax. So it can phase out and go away. There's also optional methods for calculating self-employment tax. You would use an optional method if your profit for the year is low or negative. It is possible to file a tax return with a Schedule C attached where you're running a business loss, but voluntarily opt into Social Security under an optional method. And that's basically saying, even though I don't owe Social Security tax, I want to pay it anyway. And there are a number of reasons for doing that. The first of which is gaining Social Security coverage. The optional method allows you to get a credit towards your Social Security coverage even though you have a loss or a small amount of income from self-employment. That might be important to you if you're nearing retirement age. Also, the earned income credit using the optional method may qualify you to receive some earned income credit. The optional method can give you an income amount of up to $480 that you could claim earned income credit against. Additional child tax credit. You may qualify for a larger additional child tax credit, and it could help you out. So if you go under the optional method, that might be a reason. The optional method could also qualify you for additional child and dependent care credit amounts or to claim the self-employed health insurance deduction. How do you calculate self-employment tax under the optional method? Well, there are two different methods for doing so. One is the farm optional method, and the other is the non-farm optional method. The farm optional method is usable, and you use this method to figure your net earnings from self-employment if your gross farm income was $6,200 or less, or your net farm profit was less than $4,851. Net farm profits are the total amounts from Schedule F, line 36, or from Schedule K1, box 14, code A if you have a farm partnership. The amount that you would have entered on Schedule SE, line 1, had you not used the optional method. So how do you use the farm method? Well, you go down to Part 2 of Schedule SE, and you can see that there is the optional methods for figuring your self-employment earnings, and it's pre-filled in with a number $4,480. And you do calculations according to the instructions on the form to figure out how much self-employment tax you're going to voluntarily pay. And of course, this SE tax is calculated on a profit amount that's shown there. Now, the non-farm optional method, it isn't just something you can opt to anytime you want to. You do have to meet specific requirements. If you are using the non-farm optional method to figure your net earnings from non-farm self-employment, you can do so if your profits were less than $4,851 and also less than 72.189% of your gross non-farm income. Net non-farm profits are the total of the amounts from Schedule C, CEZ, K1 from a 1065 with box 14 code A checked, and from Schedule K1 from Form 1065B with box 9 code J1. Here are the rules about the non-farm method. To use the non-farm method, you must be regularly self-employed. You are regularly self-employed if your actual net earnings from self-employment was $400 or more in 2 of the 3 preceding years that you used the non-farm method. The net earnings of $400 could be from either farm or non-farm earnings or both. That net earnings include your distributive share of partnership income or loss that is subject to self-employment tax. You can use the non-farm optional method from non-farm self-employment up to 5 times in your lifetime, not more than that. How you use the non-farm method, you fill out Schedule SE and fill out the section appropriate for it and follow the instructions. As I was sitting down at the end of today's break, I was thinking I could have had an illustration in my manual about the non-farm method, but I didn't think of it until today, so we'll save it for next year. I'll try and remember to throw it in. And then we have Section A. This is the short form of Schedule SE. I've knocked off the top. If most people are going to use the short form in Section A, and you begin by entering on line 1A your net profit or loss from your business activity. And then there is a subtraction amount here or an adjustment amount here. If you received Social Security, retirement, or disability benefits, enter the amount shown there. Then on line 2, you have your net profit from your business. You combine lines 1A, 1B, and 2. And then on line 4, there's that 92.35% figure I keep mentioning. So essentially, you take your business profit, whatever it is, and multiply it by 92.35%. If the number is less than $400 as a result, you don't owe any self-employment tax. If the number is more than $400, you do owe self-employment tax and you finish filling out the form. The next step is to take the amount on line 4, multiply that by it is 13.3%. I don't know where, sometimes I confuse myself. 13.3% is the number they want you to multiply it by. So you multiply line 4 by 13.3% and enter the result on line 5. But it does say that if your income is more than $106,800, you're going to have to do some extra computations because you're not going to owe the Social Security component of Social Security tax on the self-employment tax for the extent that your income exceeds $106,800. And then whatever the amount of self-employment tax is, you enter that on line 5. That will carry to line 56 of your Form 1040. And then from that amount, they have a formula here. You multiply the number by 57.51%, and that is the amount of self-employment deduction or deduction you get for the deductible part of self-employment tax. We used to call it 50% of self-employment tax, but it's no longer 50%. It's 57.71% or 51% that you get to deduct on the front page of your 1040 form.
Password number 2 is YOHO. Y-O-H-O.
Here is page 2, the long form of Schedule SE. You would fill out page 2 in a number of situations, and I've listed those at the bottom. If you are a minister or a member of a religious order or a Christian Science practitioner who received IRS approval not to be taxed on earnings from your religious work, but you owe SE tax on other SE earnings, you would fill this page out. If you are using one of the optional methods, you would fill this page out. If you are a church employee who reported income on a W-2 of $108.28 or more, you would fill this page out. If the total wages and tips you received during the year are subject to Social Security tax and the income is more than $106,800, you'd fill this section out. The next section we're talking about, or the next part in our class today, is just to point out that you're not done when you finish a person's federal return. If you have a client who's come into you to file their self-employment business, you have state issues that you should be concerned with. Even if you're in a state like Texas that doesn't have an income tax for individuals, most states have taxes that are imposed on businesses in some capacity. For example, in Washington State, there is also no income tax, but there's a B&O tax, a business and occupation tax. There's also sales taxes. California has an income tax as well as sales taxes, and most states have sales taxes, and businesses are going to be paying taxes at some level. They're going to often be paying taxes to the city. They're also going to be paying occupational type taxes, sales, and personal property taxes. And as a tax preparer, you should become familiar with all of those different taxes that exist in your area so that as you're working on your client's federal tax return, you can also be advising them on those other kinds of taxes. Profit or loss from farming, Schedule F. This is not by any means a class on Schedule F. I'm not an expert on farms. I do a few over the years, but I'm just a city girl. We're here in the middle of a metropolitan area, and there are farms off in the distance, but nowhere close, and so they don't come to me, although my brother-in-law is a farmer. But at any rate, I'm just going to point out a few of the things that you should know about Schedule F in case one happens to waltz in your door, sit down, and you think you can muddle your way through it. Is there anything special you need to know? Well, there are a few things that you need to know about Schedule F because farmers really do get some super special treatment reserved only for them. First off, they have their own form, and Schedule F looks a little bit like Schedule C, but not a whole lot. And I did want to point out that the form itself, you first have to decide with a farmer what method of accounting the farmer is using. If the farmer is using a cash method of accounting, you fill out Part 1. If the farmer is using an accrual method of accounting, you will fill out Part 2 at the bottom, and then you will also move over to Part 3 on page 2 for farmers who are using the accrual method of accounting. So obviously there's a lot to learn there, and you'd be wanting to read the instructions for Schedule F as you go through to make sure you're allocating everything. But I did want to point out what's similar about farmers and what's unique about farmers. The first thing about farming is that most of the forms you would ever attach to Schedule F are the same forms that you would attach to Schedule C. For example, if you're claiming depreciation, whether you're filing an S corporation, a C corporation, a partnership, a Schedule F or a Schedule C, it's always the same 4562 that is attached. There are some subtle differences on Form 4562. For example, farmers are not allowed to claim double declining balance or 200% declining balance under makers. They're only allowed 150% declining balance. So that's the first thing. The next thing is that when you're looking at a farmer, what does the farmer depreciate? Well, a farmer is going to depreciate his farm buildings, his farm equipment, but he might also be depreciating his cow. So if your farmer is running a milk or dairy operation, he would have all of his milk-producing cows, and those are going to be income-producing depreciable assets that need to be depreciated. But if your farmer is raising beef cattle to sell for slaughter, then those would be a form of inventory. So you have to kind of think about what the farmer's doing and adapt your mind. Am I dealing with a product that's being raised to sell, such as beef cattle or feeder cattle, or am I dealing with a crop that's being grown and harvested, like tomatoes? So you're going to have to be making mental calculations on that and what kind of farmer you're dealing with. The IRS has published a list of 10 key things that it wants farmers to pay attention to, or it wants tax preparers to pay attention to when preparing farm tax returns. Firstly, crop proceeds. You must include in income any crop insurance proceeds that you receive as a result of crop damage. You generally include them in your income in the year that you receive them. Sales caused by weather. If you have a weather-related condition that forces you to sell more livestock, including poultry, than you normally would in a year because of weather-related conditions, you may be able to postpone reporting the gain from selling the additional animals due to the weather until the next year. Farm income averaging. You may be able to average all or some of your current year's farm income by allocating it to the 3 prior years. This may lower your current year tax if your current year income from farming is high and your taxable income from 1 or more of the 3 prior years was low. The method does not change your prior year tax. It only uses the prior year information to determine your current year tax. Deductible farm expenses. The ordinary and necessary costs of operating a farm for profit are deductible business expenses. An ordinary expense is an expense that is common and accepted in the farming business. A necessary expense is one that is appropriate for the business. Employees and hired help. If you hire employees and farm laborers, you need to pay them with W-2s and pay Social Security and Medicare tax on the wages you pay them. That must be a problem for the IRS with farmers. Items purchased for resale. You may be able to deduct in the year of sale the cost of items purchased for resale, including livestock and the freight charges for transporting the livestock to the farm. So let's just suppose you buy young cattle, I don't know what they call them when they're young, but you buy young cows or boy cows. What is a boy cow, a bull or a steer? Okay, you buy them when they're young, and you feed them to raise them to sell. And IRS is saying that's fine, but you need to track all of the costs and treat them as an inventory item. Net operating losses. If your deductible expenses from operating your farm are more than your income for the year, other income that you have for the year, you may have a net operating loss, and you can carry that loss over to other years and then deduct it. Or you may get a refund on part of the income tax paid for past years and reduce tax in those earlier years to produce that refund. Repayment of loans. You cannot deduct repayment of a loan if the loan proceeds are used for personal expenses. You can't claim a deduction for repayment of loans, period. There's actually a couple things I haven't mentioned that you can never do. When you borrow money, the money you borrow is not income. And when you repay a loan, the repayment of a loan is not the payment of an expense. So that's the first thing that sometimes confuses people, actually frequently confuses people. The other thing you can never do on Schedule C or Schedule F is claim a deduction for charity. If you've observed, there are no instructions provided anywhere on the form for how to claim a deduction for charity. That's because you can't. It doesn't go there. Charity belongs on Schedule A. You need to itemize your deductions and claim charity there. So if in the ordinary course of your business, someone comes along and says, would you please make a donation to the Boy Scouts? You say, sure, I'd be happy to make a contribution to the Boy Scouts, and you write out a business check for that. That business check you wrote is going to carry to Schedule A and go there. It will not be an expense on Schedule C. Fuel and road use. You may be able to, as a farmer, to claim a credit or a refund of federal excise taxes on fuel used for a farm or farming purposes. And number 10, Farmer's Tax Guide. More information about farm income and deductions is in IRS Publication 225, Farmer's Tax Guide. Now, if you've ever taken a look at this guide, which I have, there's a heck of a lot of information in that guide that is very relevant to any kind of business, including depreciation and home office expenses. The guide talks about those. And the rules for them are essentially the same in Publication 225 as they are anywhere else, with the exception of some of the special depreciation rules that do apply to farmers. There are other things that you should take particular note of that Publication 225 talks about that are particular and specific to farming. And among those are agricultural program payments discussed on page 9. Elected farm income on page 18. How to do the income averaging is also on page 18. Soil and water conservation expenses are discussed on page 27. The uniform capitalization rules that apply to farmers are on page 31. Converted wetland and highly erodible cropland is on page 53. And special estimated tax rules for qualified farmers are discussed on page 84. Now, whether you are a farmer or another kind of small business owner, odds are at some point in your life you may end up in a net operating loss position. You can, of course, have net operating losses on a C corporation as well, but S corporations and partnerships don't ever produce net operating losses. They produce profit or a loss. That loss, if it happens, flows through to the shareholders and the partners who are owners. And it may trigger a net operating loss on their forms as well. So you could have a net operating loss because you have flow-through losses from a partnership or an S corporation. You could also have losses coming from your Schedule F or your Schedule C. You can even have losses being triggered by moving expenses and employee business expenses. Any of those items can trigger an NOL. And the starting point to determine if you have an NOL is to look at line 41 of your Form 1040. Line 41 of your Form 1040 is the line where you've entered or figured your income after itemizing your deductions, but before you claim your personal exemptions. And if that number is a negative number, then you might have an NOL. Now, I go one step farther and say the starting point for most people in determining whether or not they have an NOL is the adjusted gross income. If you have a negative adjusted gross income, you know you have an NOL. But even if your adjusted gross income is not negative, you might still have an NOL if you have a negative number on line 41. And if you have a negative number on line 41 but a positive number on line 38, which is the adjusted gross income line, then it would be because you have employee business expenses that are triggering the NOL. That can happen. So examples of typical losses that can produce an NOL include but are not limited to income from a trade or business, work you do as an employee. It can also be triggered by a casualty or theft. That's one I didn't mention. Moving expenses and even rental property can put you into an NOL position. The IRS has an entire publication devoted to net operating losses. It's a real gripper, not page 536 or publication 536. One of these years I'll actually put together an illustration on NOLs and probably put a course together on it. Maybe even this year, because it's a nightmarish process to go figuring an NOL. Recently I did it for a client, and not only did she have an NOL, she had the alternative minimum tax calculations for the NOL, and it was just a royal nightmare. Fortunately, what happens when you do an NOL, you'll find out if you did it right or wrong because it gets to the desk of an IRS person who's responsible for reviewing it. And if there are any questions they have about the NOL, they'll be calling you and working through a few numbers. Now, at the NOL level, once you've done all the work to figure the NOL for the federal return, you may also have an NOL for the state return, and you're going to have to do state calculations separately and manually for the state based on state rules for NOLs. So here are the basic steps in determining if you have an NOL. Step number 1, complete the tax return for the year. You may have an NOL if there is a negative number on line 41. If line 41 is a positive number, stop. You do not have an NOL. Number 2, determine whether you have an NOL and its amount. To see whether you have an NOL, figure the NOL using the instructions in Publication 536. If after you're done all that work, which is pages and pages of effort, and you do not have an NOL, stop here because, well, you don't have one. But if you've determined that you have one, you go on to step number 3. You decide whether to carry the NOL back to an earlier year or to waive the carryback period and carry it forward. Step number 4, deduct the NOL in the carryback or the carry forward year. To see how to claim an NOL deduction, look in Publication 536. If your NOL deduction is equal to or less than your taxable income without the deduction, stop here. You have used up your NOL. And if you have not used up your NOL, you can continue carrying it forward. So basically what happens is you determine you have an NOL. And the first point is, okay, am I going to carry it back or am I going to carry it forward? And for most people, the carryback period is only 2 years. It used to be 5. Briefly, during the peak of our recession, you were able to go back 3 years. That's ended for most small businesses. Most small businesses today get a choice of 2-year carryback and then forward, or just carry forward. Is there a point to a carryback? Well, there can be a big point. If you have a client that realized good income in one of the 2 preceding years and paid in a bunch of tax, an NOL carryback will allow you to go back and recover some or all of the tax paid in the earlier year. It could be a big bonus to their bottom line. The client that I recently did an NOL for got, between a 2-year period, $70,000 of refund by doing the NOL and carrying it back. So that was a big number that they went for, but a very complicated computation. So it can be worth it. But sometimes you look back at the earlier year and you'll see that if you carry back the NOL, there's not much there to grab. So it's kind of a waste to take it back. And instead, what you want to do is carry it forward. And if you decide that you want to carry it forward, you have to make an election on the tax return for the carry forward. And the election has to be made. If you fail to make an election to carry forward, the carryback is automatic. Now, most businesses are limited to only a 2-year carryback, but the following can qualify for longer carrybacks. Certain eligible losses are allowed a 3-year carryback. Farming losses are allowed a 5-year carryback. Qualified disaster areas are also allowed a 5-year carryback. Gulf opportunity zones are allowed a 5-year carryback, and specified liability losses are as much as 10 years. And certain eligible losses can qualify for a 3-year carryback. What is that? An eligible loss is any part of an NOL that is from a casualty or theft or is attributable to a presidentially declared disaster or a qualified small business or certain qualified small farming businesses. Those are the people. And if you want to know more about NOLs, I'll let you read through this here on your own. So the NOL carryback is essentially an automatic thing. If you don't want to do the NOL carryback, you have to attach a statement to your timely filed return electing the carry forward. So a lot of times what happens is the client will come in and they've got a business and it's not doing too well, and they could do a carry forward, but they don't even want to pay for the cost of the carry forward, right? So they say, no, I just don't want to pay for that form, or I don't want to pay for that service, so you don't do anything. And then really they have nothing the next year. I've run across that. But if you want to do a carry forward, you have to attach a statement, and it has to be attached to a timely filed return. If you file a timely return but you didn't make the election, you can amend and attach the statement on the amendment. But you have to do so within 6 months of the due date, the original due date of the return, excluding extensions. So I wanted to finish up today's class with a little bit of a discussion about record keeping and financial management. Because as tax preparers, if you're in the business seriously for the long haul, you're going to start to develop long-term relationships with your clients, and inevitably some of them will be selected for audit. And when they get selected for audit, you can come out the hero or you can come out looking like the bad guy, a complete bogus, dumpus. No matter how much of the blame can fall on the client will be looking for a scapegoat, and usually the scapegoat is the preparer who they think did the taxes wrong. They're not very frequently inclined to look at themselves, although I do, of course, have clients who are quite upstanding and more than happy to blame themselves for keeping sloppy records. But anytime there's there's an error on the face of the return in how a deduction was claimed, the client is certainly going to blame the preparer if they can, to try and defer blame from themselves. And one of the things that I read in it's basically a transcript of a speech given by Karen Hawkins, who is the lady who is in charge of the Office of Professional Responsibility. OPR, as it's called, is the agency within the IRS that oversees the ethical conduct of tax practitioners. And she says that when auditors do audits on tax returns and the person being audited blames the tax preparer, that information does get forwarded to OPR. And when OPR gets an accusation of misconduct on the part of a preparer, or that the conduct of the preparer was bad in terms of the accuracy of the return, and the client is blaming the preparer for that, the OPR can open an investigation and does open investigations for that reason. So as preparers, we should always be concerned about the accuracy of the returns that we're preparing. And recently, our company, unfortunately, had the privilege of having a number of clients audited. It was just part of our company was selected, and we went through the process where a number of clients were audited all at one time in a short period of time. At the end of it, we were fine. The IRS said our average error rate was we were 99% of other people they looked at had more problems than us. So we were a waste of their time. They weren't making any money on us, so they closed the book and moved on. But during that time, I got to see a lot of what was going on in audits. And the auditors are looking for a number of different pieces of information when they are verifying numbers on a tax return. The first thing is they want to see bank statements. They want to see the money that went into and out of bank accounts. And what do you think they do with the deposits? They add them up. How much money was deposited into this bank account? And then they look at all of the expenses that presumably came out of this bank account. And if the expenses are more than the deposits, that has them scratching their heads, right? So they want to be tracking the expenses that went out and matching them. And they want to see canceled checks. They want to see bank statements. They want to see who the checks were made out to, and they want to balance those checks with accompanying receipts or invoices. So they're not looking at any one thing. They're wanting to see consistency in all things that balance against each other. I've seen auditors with a receipt, a paid receipt, verification that it was paid, say to the client, prove that you paid it and that it wasn't paid by someone else. I can remember wanting to leap across the desk and throttle that IRS auditor and say, she has a magic insurance, health insurance fairy that pays her health insurance for her. Who do you think paid it? I mean, literally the auditor disallowed that expense because she couldn't show the check that she'd used to pay that health insurance, even though the health insurance company was clearly saying it had been paid. Now, why couldn't she produce the check? Paranoid. She shreds them. She shreds all of her bank statements and all of her other records. So at the time she was audited, she had to go back to the health insurance company to ask them for proof that she paid that health insurance that we'd claimed as a deduction on her return, and then the auditor did not want to allow it. I mean, I was foaming at the mouth. I was so mad. So it doesn't mean that an appeal wouldn't get us out of that scenario. But what it means is even when it's self-evident by everything there that of course they paid it, the auditor can still question it. And it doesn't mean that the auditor will win. It just means it's an issue that has to be dealt with. And the more issues you have to deal with, the more painful the audit becomes. So I try to really hammer into my clients the importance of keeping records. And as a result of that stage that we went through, we've always had a system in our company internally of when we interview something, we keep a written record of the interview, we check off, we make notes. But maybe we weren't as good at it as we could have been. You know, we're tired, it's the end of a long day, we're in a hurry to get this thing out. Do I need to spend another 10 minutes making written records of everything I did and why, or can I just shove it through and say I'm done? And it's easy enough to say I'm done and shove it through. We learned in the audit process that's not a good idea, that you, as a tax practitioner, you cannot keep too many records. And so we've actually, internally in our company, developed a whole series of organizers for small business. And every business return we ever do, that client either has to produce for us their own profit and loss, or we work with them to figure their profit and loss and fill out this worksheet with a profit and loss and have them sign off on it. So that there's never any question about where the numbers came from, that they've seen them and they've agreed to them. and this is just how we cover ourselves as tax practitioners, because the day is probably going to come where any person in the audience here today listening to me is going to be sitting there in the audit and having to defend the positions they took on a return and where their numbers came from. And very often the numbers came from the hat of the client. Yeah, my expenses were this, my expenses were that. And actually, I absolutely cannot stand it when a client tells me what their numbers are. I don't like it. If you want to tell me what your numbers are, here is the sheet. Write them down. I'm not a dictator. I'm not going to go through dictation on your expenses. I want to know what they are. I want you to sign off on them. So that's the first thing. That's the side I'm looking at as a preparer, protecting myself. But the second thing is giving good advice to your clients on why they should keep records. There's a couple of reasons why you should keep records. Lots of reasons why you should keep records. If you're in business, shouldn't you want to know how much money you're making? I mean, personally, I do. I want to know how much I can put down on the loan application when I'm buying that car or that house. I want to know how much I can qualify for based on real income numbers. I want to know, am I making a living that's worth staying in my current profession? Maybe I should just shut this business down, get a W-2 job somewhere else with a whole lot less stress, because it's just not worth it being self-employed with how much I'm making. And how do I know how much I'm making if I can't even keep records of what I'm making? So how do we get our clients to start maintaining those records that they're naturally inclined to not be very good at? Because after all, most small business owners are wearing many, many hats, trying to do many, many things at once. And record keeping is something that's not inherently easy to do. It takes time. And if you don't fully understand the importance of it, you can get even worse at it. So some people are good at it and understand it's important, but most people don't understand the importance or are not good at it. So what I tell my clients to do in the interview is I say, okay, well, you've told me that you've got a bunch of expenses that you don't have receipts for them, you don't have canceled checks for them, so we really can't put those on your return. I mean, what evidence do you have that you ever had those expenses? So what you should start to do is maybe just keep an envelope, one of those big brown vanilla envelopes, in the glove box of your car or in the door, in that pocket door of your car. And whenever you pay cash for something, as soon as you get in the car, stuff it in there. And even if you don't empty it all year, when the year ends and you come in for me to do your taxes, you've got it in your hot little hands, right? So that's one system. The other system I tell them is keep your business life and your personal life separate. Open up a business account and don't put personal money in it. Open up a business account and don't put, open up in your personal account, don't put business money in it. Just keep the money separate. And if you're purchasing business expenses with a credit card, use one credit card only for the business and another card for personal. It's just the simplest thing in the world to do that, and then we don't have to sort through it. And the auditor doesn't have to sort through it. When you've got an auditor, they're not going to do your bookkeeping for you. That was the other thing I learned. Clients seem to think, well, when the day comes that the IRS audits me, they're welcome to. I'm just going to give them this mess and they can go through it. They don't. Well, they want to see your P&L, and then they will balance the records that you have to prove lines, independent lines on the P&L. Or if you've got a line on your tax return, they may look through your records trying to see how you arrived at a number that you entered on your tax return. So if on the tax return you claim an advertising expense of $5,000, they will go through to look for the record that proves $5,000. And if they can't find it, they'll disallow it. So it's not a situation where the auditor is going to do all of that bookkeeping work for you. It's a situation where if you deliver them a mess, you're going to owe, because they're going to start saying, I couldn't find it, I couldn't deal with it. And a certain amount, they will put a certain amount of time into it. I've seen auditors put a lot of time trying to sort through stuff. But there is a limit to what they'll do. And ultimately, my idea of a perfect audit is the in and out audit. That we're in there, we verify every line they have a question about in 3 to 4 hours, and it's over. Out the door, no more requirements of us. The book's closed. I've been in audits like that. They're the best kind. So why do we care about keeping records? Firstly, to prepare and file accurate tax returns. Also, we need to be able to complete loan applications to purchase important things in our life like cars and houses, to plan for our retirement, to make important career management decisions. Like I already said, am I going to stay in this job or get a new one? to manage money and live a financially secure life that is free of some level of stress about worrying about where the next money is going to come from. And finally, to save money on taxes, because if you keep lousy records, you're probably paying more tax than you should be. Ralph L., you have said 6,200, you have 6,720 in the course. What are you talking about, Ralph? Don't know what you mean by that. All right, minimum standards for record keeping. Well, here's the deal. We talked a little bit earlier about QuickBooks. And in the classroom here, actually, during our lunch hour, I mentioned my father is a CPA, and he got involved in taxes recently. For most of his life, he's been an accountant. And in Canada, when I was growing up, he managed a company in Canada called Associated Grocers. He was their Minister of Finance, he was called, and he was in charge of all of the accounting systems for a fairly good-sized business that owned supermarkets and distributed lots of food all over the country. And at that time, and this was in the early days of the computer industry, not of the computer industry, but just of a computerized accounting, he was developing an entire computer system for this company. At the infancy of this stage where there really was no accounting software out there, he was helping develop it for this company. And over the years, he has had an opportunity to work on many, many, many different accounting systems. And he says the best of all of them is QuickBooks. That's the one that he likes. And it's cheap. Off the shelf, $100, you buy it. But of course, because it's cheap, it makes it easy for people who don't know what they're doing to get their hands on it and do really incompetent work. It also makes it easy for small business owners to think, oh, I've just started up my own small business. I'm going to go out and buy QuickBooks and do it myself. And my clients often ask me, is that something I recommend? And my answer is, heck no. Now, there comes to be a point where I might say, possibly yes. You're at a point where you've got enough going on that Excel spreadsheets are getting a little bit cumbersome. QuickBooks could make it more efficient, but only if you get it set up properly. So I would recommend that you sit down with our firm or someone else who is very proficient at QuickBooks. There are people out there who are called Certified QuickBooks Pro Professionals, the people who have passed a certification test that QuickBooks has on itself. And if you pass that test, QuickBooks will certify that you know what you're doing in QuickBooks. If you find someone at that level who's really savvy on QuickBooks to help you set your business up in QuickBooks, and then periodically they audit your work and make corrections, QuickBooks can be good. But that's a lot of work and a lot of time. And the amount of money you would spend doing that might just as well be spent on paying someone else who knows what they're doing to do it for you in the first place. But aside from that, most small businesses simply just don't need that level of accounting. Most small businesses are good with the shoebox, quite frankly. Now, a shoebox is a little bit of a pain in the butt sorting through everything, but I actually don't mind shoeboxes that much because they're kind of clear-cut. There's a real receipt in front of me with a real number on it. I can deal with that. I'd much rather have that than the number out of the hair. But what do I recommend to my clients? The first thing is I give them a list like this one on how to categorize expenses. Categorize expenses into useful categories. I have a few clients over the years that have insisted on categorizing expenses by the months that they're paid. It makes sense to them. But it's worthless at tax time, and I pull my hair out. I don't care what you paid in the month of January. I need it categorized the same way the tax return is. So I might give them a list like this one and just print it out and say, here, these are the types of categories you should have. Put manila folders together, and every time you have an expense, put the receipt for that expense in the correct manila folder, and then bring me your manila folders. I'll add them up. I'm happy to do that. So that's one way. The other way is maybe they'll keep their own manila folders, and then they'll do a spreadsheet. And really the best spreadsheet out there is something like Excel. There's also a freeware version where they can just go in and add all their own receipts up in, and then they can give you the spreadsheet, and you just can click sum total and do it. So those are the advice that I have for my clients, and we have those discussions frequently and regularly about which way to go. The last page in the manual I have for you is page 27 of publication 453. And I thought it would be important to show you this because this is an actual written record of what IRS expects a taxpayer to have as evidence of an expense. And in particular, this one is talking about travel, entertainment, gifts, and transportation. And you will see in here that the IRS wants the taxpayer to be able to identify the amount of each separate expense for travel, the amount paid for lodging, the amount paid for meals, the amount paid for taxi rides, etc. It wants to know the business purpose of the trip. So it wants to know a lot of information about how you justify that. And as tax preparers, these are the types of conversations we should be having with our clients.
Password number 3 is Breen, B-R-E-E-N, Breen.
And it is now time to complete the classwork assignment for sessions 20 and 21. Our classwork assignment involves a complex tax return. We're going to be preparing Snow White's tax return, and she is self-employed with a child daycare business that she operates from her home. You will need to prepare for her Form 1040, Schedule C, Schedule SE, 8829, 4562, and a 4797. Sounds like a big job. Snow White runs a child daycare business from her home. She is licensed by the state. Snow White was widowed in 2010 and has not remarried. Her 2 children, Grumpy and Happy, lived with her all year. She paid $2,575 for family health care premiums. Snow White had the following income and expenses for the year 2011. Income from childcare was $60,000, and expenses that she incurred included food for the children, toys, a video game machine that she bought on October 15th, outside play equipment that she bought on 11/15, and she had the following household expenses: rent that she paid for her home, utilities, and maintenance on the home. Snow White's house is 1,800 square feet in size, and she allows the children to use all of the rooms in her house except her bedroom, which is 200 square feet in size. She cares for the children in her home 8 hours per day, 5 days per week, and she does close her daycare for 2 weeks each year so she can take a much-needed vacation. Her car expenses included gas at $1,100, interest of $1,200, and repair expenses at $500. Snow White paid $7,000 for a 2006 Dodge Caravan to use in her business on 11/15/10. The 2006 Caravan was purchased to replace an older 2011 Plymouth Voyager Snow White had been using in her business since 2008. She drove the car 15,000 miles during 2011, and 2,000 miles were for business. 1,000 miles were before 7/1 of 2011, and 1,000 miles were after June 2011. On 1/15/11, Snow White sold her 2001 Plymouth Voyager for $1,500. Snow White had accumulated the following mileage amounts during the years she owned that Voyager. So for the Voyager that she sold, her old 2001 Voyager, we show you the business miles that she had for each year of ownership and the personal miles she had for each year of ownership. But she has no business or personal miles that she put on the car in 2011. Snow White claimed the standard mileage allowance all 3 years that she was using that Voyager, and she originally purchased the Voyager on January 31, 2008 for $4,000. Prepare her federal tax return. So at this point, please push pause on video playback and prepare Snow White's tax return. When you are finished preparing Snow White's tax return, please resume video playback for a review of the answer key. And now let's take a look at the finished tax return for Snow White. And beginning at the very top of the 1040, what is her filing status? Well, Snow White was widowed in 2010, and she has 2 qualifying children. So she is a qualifying widow with dependent child, and that is the filing status that we use for her. In addition, remember in the space provided on the Form 1040 form, you should write 2010 because that is the year of death. Now, Snow White has 2 dependent children. Both of them qualify for the child tax credit, so you should make sure to check those boxes. So in preparing Snow White's tax return, we are going to need to complete a Schedule C and a Schedule SE. I will show you the Schedule C in just a moment, but I also wanted to review the Form 4797. Form 4797 is required whenever a business sells an asset. Well, Snow White sold her Voyager that she had used in her business for 3 years. And because she was using that van in her business, she claimed depreciation on it. She claimed the depreciation through the standard mileage allowance. And when she sells that van, she is selling an asset that was used in her business. Therefore, the sale needs to get reported on Form 4797. And to figure the amount to report on Form 4797, we need to figure her business use percentage on that van over the time that she owned it. To do that, we look at each year and take the mileage for each year. And in the wording of the problem right here, I told you that what her business miles were and what her personal miles were, so we've just transferred that information over into a table. We've totaled up the business miles for all 3 years as being $7,500, and her personal miles are totaled at 22,500 miles, and that gives her total miles by taking personal plus business, and those total 30,000. Next, we determine what percentage of 30,000 we have when we have business mileage at 7,500 miles. And 7,500 divided by 30,000 gives us our business use percentage. It is 25% business use. Now we look at the purchase price of the vehicle and the sales price of the vehicle and multiply those amounts by the 25% business use. Snow White purchased the van for $4,000. We multiply 4,000 by 25% and we get $1,000. If it sells for $1,500, we must also multiply the sales price by 25%, and when we do that, we get $375. So on the surface, it would appear that Snow White has a $625 loss. She sells the van for $375, but she paid $1,000. But we need to account for her adjusted basis in the van. Her adjusted basis means that her cost may not actually be $1,000. It's probably going to be something less than $1,000. So let's look into that. Prior depreciation on the van is calculated as follows. We look at the business miles placed on the van each year and the portion of the standard mileage rate for each of those years that is for depreciation. And we have 21 cents for 2008, 21 cents for 2009, and 23 cents in 2010 that is for depreciation. We multiply those mileage rates out by the number of miles driven and then total them up. We get $1,615. So let's see what happens then. If the cost of the van is $1,000 and prior depreciation claimed on the van is $1,615 and we have a sales price of $375, it means technically there is no loss on the van, there's actually a gain. Snow White sold her van for a net gain. She must recapture depreciation on the van to the extent of her gain. Snow White has sold the van at a gain because using the standard mileage allowance has allowed her to reduce her basis in the van technically to below zero, negative $615 actually. Now, IRS says that under the rules for determining basis, your basis can never be reduced to below zero. And technically, Snow White's overall basis in her van is $4,000. It's just that the business use portion of that van used up more than her business use basis. And that's where we're getting the negative $615. So Snow White will need to complete Form 4797 as shown here. She will enter $375 as the sales price, $1,000 as her cost basis, $1,615 as depreciation allowed, giving an adjusted basis of negative $615. We're going to enter a net gain of $990. So we sell for $375. We add $375 to $615, and that gives us a $990 profit on the sale of the van, and that profit needs to be entered on the appropriate line of Form 4797, and then it carries to Form 1040 and is entered on line 14. For the Form 8829 business use of home, we need to do computations for the business use percentage on the home, and so we'll show you how we computed those. But one of the things that is required for figuring business use on the home is the number of hours of business use in a daycare business. If Snow White is open for business 50 weeks out of the year, 5 days per week at 8 hours a day, you can't do simple math to come up with 2,000 hours per year, and we need to know that number for use on the form. So we'll show you that in just a bit. For depreciation, the video machine and the refrigerator are depreciable assets that need to be entered on Form 4562, and we'll show you that. And then, of course, in Part 5 of Form 4562, Snow White needs to enter her business use vehicle information. which does include the standard mileage allowance. She drove 1,000 miles in the first half of the year, 1,000 miles in the second half of the year, and that gives us $1,065 of standard mileage amount to enter as an expense on Schedule C, line 9. And here is Snow White's finished 1040 form. You can see that we've entered her filing status as qualifying widow with dependent child and entered the year of birth. She has 2 children, Happy and Grumpy, who both qualify for the child tax credit. The total exemption she's claiming is 3. Next, we can see on line 14, we have entered the $990 gain from the $47.97. I'll show you the form in just a minute. And you can also see that we're entering a profit on her self-employment of $51,950. Pretty hard to arrive at that number without taking a look at the form, so let's go do that next. And here is Snow White's Schedule C. We can see that the principal business activity is child daycare provider, and the name of the business is Snow White Daycare. The business code that we've entered is 624410, and we've entered the business address. The accounting method for Snow White is cash. The question G asks, did you materially participate in the operation of this business? And obviously Snow White did. Then it says on item H, did you start or acquire this business during the year? Check here. No, we did not start it during the year. Item H, did you make any payments in 2011 that would require you to issue Forms 1099? We have said no to that question. We provided you no information to believe that they are required. In Part 1, under Income, we show on line 1B the gross receipts of Snow White's business. In the wording of the problem, we've provided you the income and expenses for Snow White. Those transfer over to the Schedule C. On line 1B, we enter $60,000 of gross receipts. And then we move down to line 9 and enter the $1,065 of auto expense that was calculated using the standard mileage allowance. We have $700 of depreciation, and I'll show you how we calculated that in just a minute. In the meantime, on the interest line, we have another item of $160 of interest expense. Where did that come from? Well, let's take a look here. Under car expenses, we have interest of $1,200. Snow White used her van for a certain amount or percentage of business use, and we're allowed to claim an interest expense on an auto loan on a car that has business use on Schedule C, not on a 2106, of course. So what we're going to need to do to figure this $160 is to figure out Snow White's business use percentage. So let's go back up to the wording of the answer key. And you can see under the Schedule C description, it says for line 16B, enter $160. The car loan interest is deducted pro rata based on 13.33% business use. 13.33 times $1,200 is $160. So where did we get that business use percentage? Well, we see here that Snow White drove the car 15,000 miles during the year, of which 2,000 miles were business miles. So 2,000 divided by 15,000 is 13.33%, and we get 13.33% of the car loan interest. That's $160, and we enter that on the interest line of the Schedule C right here. Next, we have supplies, line 22, and in the wording of the problem, we provided you with toys for the children and food for the children. $1,200 plus $3,200 is $4,400. And we total up the expenses on Snow White's Schedule C, line 28, we have $6,325, giving her a tentative profit of $53,675. What else do we need to be concerned about? Well, we need to figure her office use of home expense, and for that we need to complete an 8829. And here is Snow White's 8829. On line 1, we enter the area of the house that is used regularly for business, and that's 1,600 square feet. The total square footage of the house is 1,800 square feet. How did we figure that out? Well, we told you that the house is 1,800 square feet and that the children have the run of the house except Snow White's bedroom, which is 200 square feet. So 1,800 minus 200 is where we get $1,600. Then on line 4, we enter the number of hours of business use in the year. I just showed you how to compute that. We have 2,000 hours of use during 2011 for Snow White. And in 2011, there were 8,760 hours in the year. 2,000 divided by 8,760 is 22.83%. And 1,600 divided by 1,800 is 88.89%. 88.89 times 22.83 is 20.29% for the year, business use. On line 8, we enter the profit shown on the Schedule C, and that was $53,675. Next, we enter the expenses that Snow White has for her home, and we gave you those expenses right in here. We told you that rent was $8,000, utilities $200, and maintenance $300. We enter $8,000, $300, and $200, and those total $8,500. We then multiply $8,500 by 20.29%, and that gives us $1,725. That $1,725 is not reduced by the profit on the business because the profit on the business is more than $1,725. So $1,725 will be carried up and entered on Snow White's Schedule C, right here on line 30. We subtract line 30 from line 29, and that gives Snow White a profit on line 31 of $51,950, which is the amount entered on line 12 of her Form 1040. And here is Snow White's Form 4797. We use this form for figuring the profit on the sale of the Voyager. And on line 19A, we've entered a description of the Voyager. We've entered the date acquired and the date sold, the sales price, the purchase price, the depreciation claimed, the adjusted basis, and the total gain from the sale. The depreciation allowed or allowable was $1,650. The gain was $990. We enter the lesser of those two amounts down on line 30 and 31. We then move over to page 1 of the form, carry that $990 to the front, and the final step is to enter $990 on Snow White's Form 1040, line 14. Next, we move on to Snow White's Form 4562, and here it is. Snow White placed in service a refrigerator during the year costing $550, and she has listed property from page 2, which is the video game machine. The video game machine cost $150. She has elected to expense that. $150 from page 2 of Form 4562 is carried over and entered on line 7. You add line 7 to the depreciation under Section 179 claimed on line 6. Those amounts total up to $700. She's not claiming any maker's depreciation. Her total depreciation deduction of $700 carries to Schedule C and is entered on line 13. So finishing off Snow White's tax return, we come to line 27 where we claim the deductible portion of her self-employment tax, and to figure that we needed to complete a Schedule SE. Here is Snow White's Schedule SE. We begin by entering the profit from her business. We multiply that profit by 92.35%. That gives us $47,976. And we then multiply $47,976 by 13.3%. That gives us $6,381. And then on line 6, it says, figure the deduction for the employer equivalent portion of the self-employment tax. And we take line 5, multiply it by 57.51%. And when we do that, we get $3,670. $3,670 is the amount of self-employment tax deduction that Snow White will claim on page 1 of her Form 1040, and $6,381 is the amount of self-employment tax she will enter under the taxes section of page 2 of her Form 1040. So here is Snow White's deductible part of her self-employment tax. $3,670 is entered on line 27. Then on line 29, we have her health insurance premiums, and we told you in the wording of the problem right here that she paid $2,575 for family health care premiums. Those are entered on line 21. We total up her adjustments, and we have $6,245. We move over to page 2, and on line 40, we enter her standard deduction for a qualifying widow with dependent child. That's $11,600. She's allowed 3 exemptions that total $11,100, and that gives her taxable income of $23,995. The tax on that, using the tax tables, is $2,746. Or she is allowed a $2,000 child tax credit. That reduces her tax down to $746. Next, we compute the amount of self-employment tax that Snow White had on Schedule SE, and then carry the total $6,381 to line 56. That adds to her regular tax and brings her total tax bill to $7,127. And you can see in this illustration that Snow White actually has a very small income tax liability based on her income and her deductions, but her self-employment tax liability is very large, and therefore she owes $7,127 as she is filing her return. So that concludes the review of the Session 20 and 21 classwork assignment. Let's take a look at the homework assignment next. And the homework assignment from the Session 2021 manual begins on page 109 of the manual. The forms needed to complete this assignment include 1040, Schedule C, Schedule D, Schedule SE, Form 4562, 4797, 8594, 8903, and the Qualified Dividends and Capital Gain Worksheet. So this is quite a big job for you. This is a really good exercise that you should pay close attention to because it really is a prelude to what will be the Open Book Final Exam for our course. The Open Book Final Exam is a completely different assignment, of course, but this particular return has in it many of the details that you will find in the Open Book exam. So do put extra care into this assignment, really thinking your way through it. It'll give you a good baseline when you move on to preparation of the Open Book Final Exam. Jean-Luc Picard lives at 120 Federation Way, and in 2010 he began searching for a business to purchase. He spent $15,000, $7,500 in 2010, and $7,500 in 2011 for research and travel expenses relating to his search for a suitable business to acquire. And the company has a staff of 6 employees, 3 working in manufacturing and 3 in administration. All income from the business is qualifying domestic activity income for purposes of calculating the domestic production activities deduction on Form 8903. The purchase price of the business is broken down as follows. We have allocation of purchase costs per the tax return with inventory at $300,000, assets shown here, and he also has additional costs of the SBA loan origination fee, SBA business appraisal fee, and we then have total acquisition cost of the business at $1,125,000. Jean-Luc wants to depreciate the furniture and equipment straight line ADS. He wants to depreciate the computer system Maker's double declining balance. He will not take bonus depreciation on assets placed in service during the year. At the time he purchased Enterprise, Jean-Luc owned a Dodge Caravan, which was his only vehicle. He began using the van for business purposes when he purchased the business. Jean-Luc purchased the van in 2007 for $30,000. The van had a fair market value of $8,500 when he began using it in his business. During 2011, Jean-Luc put 20,000 miles on the van. 2,000 were commute miles and 7,000 were enterprise business miles. 4,200 of those miles were before July 1st and 2,800 miles were after June 30th. Jean-Luc wants to claim the standard mileage rate for his business use of the Caravan. On 10/20 of 11, he sold the van for $8,000. On 10/15 of 11, Jean-Luc purchased and placed in service a GMC Yukon. The purchase price of the vehicle was $52,000. The Yukon is a light truck that falls under the IRS rules covering SUVs. This means the Yukon is listed property that is not subject to the limits on depreciation for automobiles, but is limited to a maximum Section 179 deduction of $25,000. Written records for 2011 indicate that the vehicle was driven 9,846 miles, 5,700 business miles, and 4,146 total non-business miles, of which 1,000 miles were commute miles. Jean-Luc wants to claim a Section 179 expense deduction and accelerated depreciation on the Yukon. He will not claim the standard mileage rate for business use of the Yukon and will claim actual expenses. Operating expenses for the Yukon were as follows: gas $1,000, new tires $600, insurance $2,000, interest on a loan to purchase the Yukon was $1,500. Enterprise operates on the cash method of accounting and uses the cost method for valuing inventory. Ending inventory on 12/31 of 11 was $350,000, and the short year P&L for the period ending 12/31 is shown next. We have gross receipts for Jean-Luc's business enterprise totaling $1 million. We have materials at $400,000, shipping in is $50,000, and the cost of labor $100,000. His total cost of goods sold is $550,000. For expenses, he had health insurance of $10,000, of which $1,000 was for Jean-Luc's personal health insurance. And then he also has W-2 wages and salaries totaling $100,000, advertising of 50, telephone of 5,000, utilities of 10,000, rent at 50,000, and SBA loan interest expense amount of 50,000. Travel for airfare and lodging with $5,000, and travel meals were 1,000. Local entertainment expenses were 2,000. Payroll taxes 30,000. Milky Way business license $1,000. Shipping and delivery $50,000 for total expenses of $363,000. So your job at this point is to complete Jean-Luc's tax return. This concludes session 2021 of the Basic Tax course. I'll see you next time at the beginning of session 22. Bye-bye.